Welcome. Let's be clear. This is not a forecast based on market sentiment.
Not at all.
This is a critical risk assessment for Q1 2026. Our focus, for your interests, is capital preservation. Pure and simple. We've dug through the data streams, and what we're seeing is a fundamentally bifurcated environment. There's a severe structural debt problem hiding right under the surface of all these optimistic growth headlines.
That's right. And to navigate the coming quarter, you really can't just be looking at tech multiples or, the daily tape.
Yeah.
You have to look at the liability side of the balance sheet. There is a known quantitative and, frankly, unavoidable risk event coming.
A calendar entry, not a prediction.
Exactly. The volume of U.S. corporate debt that is about to hit its maturity wall is set to break records in March 2026.
So for this deep dive, we've boiled it all down. We're looking at three crucial macro divergences that we believe demand immediate defensive action. A portfolio rotation.
We're going to spend most of our time on the biggest piece, that ticking liability in corporate debt. That's the known systemic risk.
Then we'll cover the energy pivot that we see as the defensive hedge. And finally, the shift in consumer habits that actually offers some resilient growth.
But the lens for all of this is purely defensive. We're focused on insulated value.
Okay, so let's unpack the mechanism here. Where does the pain start?
It starts, logically, where the biggest quantifiable risk lies, corporate liquidity. We need to understand the scale, and maybe more importantly, the velocity of the shift.
Let's set the stage then, the context that got us here. For the last decade, post-GFC, we basically had free money.
Right, an era of 2% interest rates.
Exactly. So companies all across the spectrum, mid-caps, even the bottom of the small-cap index, they just borrowed heavily. 5, 10-year debt.
And now those same companies are staring down a forced refinancing cliff. The replacement cost for that capital isn't 2% anymore.
It's suddenly in the 7–7.5% range.
And for many, the simple act of rolling over debt becomes a catastrophic expense. The liquidity tap is closing hard.
What's really striking is the duration mismatch. I mean, they issued all this debt, assuming rates would stay low forever.
That duration risk was never priced in by management teams. Never.
So when the Fed went on its hiking cycle, it just fundamentally rewrote the rules for every capital-intensive business in America.
Think about it. If you're a company running on, say, 5% operating margins, and your interest costs jump from 2 to 7.5%,
You can't operate profitably. It's that simple.
you just can't. And that leads us directly to the core problem we need to assess for you.
The rise of the zombie company.
Yes. And we need to be very precise with the definition here. For our purposes, a zombie is a company that cannot cover its interest payments with its current operating profits.
So these are firms just running on borrowed time.
Completely. They're surviving by rolling over debt or just burning through their cash reserves. They are non-productive, capital-intensive businesses.
And this is where the scale of this thing becomes, well, alarming.
It is. Our analysis shows that over 15% of the entire Russell 2000 index now falls into the zombie category.
15%. Let that sink in.
It's a staggering figure. If you're holding a diversified small-cap portfolio, you are, by default, exposed to systemic ill health on a scale we haven't seen since the late 90s.
You know, I look at that 15% metric, and I see a fundamental signal of systemic rot. And frankly, I'm worried the market is way too complacent about it.
Well, the term zombie has been floating around for a year or so.
Right, but the sheer volume. 1 out of every 7 small-cap businesses. It creates an inevitable friction. It tells me that when the defaults start, the contagion isn't going to be isolated.
Because of the credit lines, the supply chains.
It's all interwoven. The structural weakness, this huge chunk of companies that needed cheap capital to survive. You just can't ignore that when you're modeling risk.
I agree. I agree that the 15% is the canary in the coal mine. It signals that structural ill health. But my deep concern is a bit more specific. It centers on the March 2026 refinancing cliff.
Ah, the timing.
The timing. The market seems to be pricing this in as a slow rolling problem, a gentle slope of defaults over the next 2 years.
And that's the critical mispricing.
That is the mispricing. This isn't a generalized risk. It is a hard, concentrated deadline. We are talking about a mandatory rollover from 2% capital to 7.5% capital.
All at once.
It's happening simultaneously across a massive slice of maturities in a single quarter.
The velocity is the critical factor.
Exactly. That simultaneous shift is the specific non-negotiable catalyst. It guarantees an acceleration of defaults in that specific quarter. March is when the debt bomb detonates for the credit markets.
The highest concentration of debt maturity hitting the highest rates.
The potential velocity of that pain is what demands immediate portfolio action. We have to assume the credit markets will freeze, or at a minimum, tighten significantly that month.
So the thesis is clear. The volume, the 15% exposure signals the depth of the rot. But the timing March 2026 dictates the urgency. For a capital preservation strategy, this means immediate restructuring. We have to rotate away from capital-intensive, low-margin sectors.
Especially in that small cap space.
Absolutely. The ones that thrived on cheap debt, the ones with high debt-to-equity ratios, we are exiting the potential blast radius.
Which brings us to the key question then. Where does the capital go?
Right.
We have to shift from just avoiding risk to finding defensively sound insulated value. When money is expensive and liabilities are piling up, capital has to migrate to assets that don't rely on the banking system to sustain their value.
Which takes us to hard assets.
It has to.
And here's the next macro divergence. For the last, 2 years, the only growth story has been AI-driven growth.
The singular narrative.
But that narrative completely ignores the foundational physical resource requirements for that AI infrastructure.
It's a classic case of admiring the penthouse suite while ignoring the plumbing. The compute load to run data centers, these large language models, it's astronomical.
They need massive, uninterrupted power.
24/7 baseload power. And our data points to a glaring, massive energy deficit. It's inevitable. The current build-out of solar and wind is it's demonstrably insufficient to meet this exponential demand spike.
Supply and demand dislocation.
That absolutely favors specific foundational commodities.
And the structural commodity strength that results is undeniable. I mean, if you look specifically at physical uranium, U3O8,
The fuel for nuclear baseload.
which is what you need for uninterrupted data center supply, prices have surged 14% this month alone.
And we need to be clear. This is not speculative retail trading. It's not a reaction to some geopolitical headline.
No, this is a deep institutional footprint. We're seeing large-scale funds, and we can name names, like Sprott, quietly accumulating physical inventory.
Through their trust structures, they are taking tangible supply off the open market permanently.
They're hedging the energy deficit required to power the future economy.
And that trade is structurally compelling. The long-term contracting model in the uranium market insulates prices from short-term volatility and, importantly, from financing rates. It is a genuine defensive hedge.
So this structural demand, driven by the future of computing, is critical. For your portfolio, this exposure can be accessed through equities like the big producer Cameco, that's CCJ, or the pure physical vehicle, the Sprott Physical Uranium Trust, SRUU.
It's a clean rotation.
A very clean rotation away from the risk in the Russell 2000 debt stack and into a necessary commodity supply.
Okay, now let's pivot. Let's connect those macro pressures, the rising rates, the inflation, directly to the consumer. This is the third divergence.
And the signal here is just as clear and, frankly, just as alarming.
Credit card debt. It has hit a new peak of $1.4 trillion.
$1.4 trillion. That level of liability, combined with today's high interest rates, is fundamentally changing how households behave.
And you can see the behavioral consequences everywhere in the retail landscape. Shoppers are abandoning luxury, even mid-tier brands. They're trading down aggressively into extreme value retail.
They have to. They're conserving capital because their debt service costs, mortgage, auto loans, credit cards, it's all rising faster than their wages.
And this gives us the quantitative evidence of a profound market shift. This household budget stress translates directly into top-line outperformance for the retailers that are optimized for ruthless efficiency.
Specifically, we've noted that Walmart and Costco have recorded a 22% increase in high-income shoppers.
And that's the key data point. These are families making over $100,000 a year.
So this isn't just low-income consumers cutting back.
No, this is a permanent habit shift. It's driven by high-net-worth individuals making tactical decisions about their consumption.
This is where we have to reframe the data. A lot of conventional analysts see this trading down trend, and they just label it a defensive move against a cyclical recession.
Right, a temporary blip.
But we conclude it's actually a robust growth play for 2026. The sustained pressure from inflation, from high personal debt service burdens. It suggests these habits are becoming sticky. They're becoming permanent across all income levels.
So the efficiency leaders win, regardless of the macro environment.
Exactly. It's a resilient growth that doesn't need cheap debt to fuel it, which makes it the perfect complement to a hard asset play.
Okay, so to summarize this deep dive for you, we have identified a severe macro divergence, and it's fueled by the quantifiable risk of that March 2026 debt cliff.
Hmm.
This divergence necessitates a rapid rotational shift focused purely on insulation and capital preservation. Our defensive prescription is twofold. First, we move into hard assets like physical uranium to hedge that energy deficit.
And second.
And second, we rotate capital toward resilient consumer plays like extreme value retail, which demonstrably benefit from strained household budgets and permanent value-seeking behavior. Both strategies are focused on insulated, non-debt reliant value.
And here's a final provocative thought for you to consider as you review this data. We established that consumer credit card debt is at a peak, $1.4 trillion.
Right.
We also identified the severe risk from zombie companies in the small cap space, 15% of the Russell 2000, employing a significant number of people.
A very significant number.
So what percentage of that 1.4 trillion in consumer debt is currently being serviced by wage earners who are employed by those very same zombie companies?
A feedback loop.
Exactly. And what happens to consumer spending when the corporate defaults accelerate that feedback loop? That is the next layer of systemic risk we must anticipate and hedge against.
A crucial question.
For our continuing synthesis of complex data streams and structural risk analysis, we recommend you subscribe to the Wall Street Trends channel.